We're almost midway through the calendar year and stocks define expectations in the first half of 2023. But with sky-high inflation and rising fears of a potential recession, investors are searching for the most promising industries. Jill Malandrino, Nasdaq Global Markets Reporter, joins us now. Good to see you, Jill. I mean, we're seeing inflation moderating, but consumers are still feeling the pinch of higher prices. What will happen when consumers do run out of their pandemic savings?
Most of that money has been spent as the savings rate has dropped from an average of around 9% before the pandemic to around 3% in the final quarter of 2022. Many households still have more cash on hand now than they normally would want, but how much of that will they spend as the economy slows? One possibility is that many consumers will remain cautious and hold on to those savings even as they are able to go out and spend. Another possibility is that spending booms for a while longer as post-pandemic revenge spending on travel and consumer services continues to grow. Deloitte analysts forecast continued job and income growth will support sustained growth in consumer spending, but spending will slow as the savings rate eventually rises back to the 6% range. While spending on services has continued to gradually expand, spending on goods has been volatile. Recent PMI data suggests that the services sector is beginning to cool. The Conference Board expects high interest rates to further dampen spending on goods and forecasts that overall consumer spending will grow in the second quarter of 2023, but anticipate a contraction in the second half of 2023. During economic downturns or recessions, in this case, a recession that has yet to materialize, consumer staples tend to perform relatively well because they are essential products and would be considered defensive investments. That said, consumers may be more sensitive to further price hikes than they were to the past price hikes that took place in 2022, particularly if the economy softens further and the unemployment rate rises. Those best positioned for this backdrop may include companies that can raise prices further without losing sales volumes. Analysts at Fidelity point out two bright spots. Consumer staples companies with exposure to emerging markets could also be well positioned to weather any further economic storms in 2023. Many of these countries have a fast-growing middle class, leading to higher per capita growth in developed markets. Plus, many emerging market nations have been battling inflation for decades, which means consumers are used to seeing prices rise and less likely to change their purchasing decisions in reaction to price hikes. Finally, consumer staples companies that make private label products may hold up well as their lower price points attract consumers.
And Jill, we've really seen the tech stocks rallying this year, sort of lifting the rest of the S&P with it, but with the tech-heavy Nasdaq Composite up about 28% year to date. So what can we expect from the sector later this year?
Yeah, I mean, it certainly has been quite a year for the Nasdaq 100 in particular, which doesn't have financial exposure, which is why we tend to see it go a little bit higher than the composite. Virtually every company in every industry is now looking to use technology to get closer to its customers, innovate more quickly, and operate more efficiently. Many firms are embarking on multi-year digital transformation projects, and this may only accelerate as companies adapt to hybrid work environments. Companies that provide the technology to aid in these transitions could be potential beneficiaries of this trend. That includes the cloud, generative AI, and ML. Increasing adoption of cloud computing continues to be disruptive influence as enterprises shed their in-house hardware-based architecture in favor of cloud-based systems. And because of these hybrid environments and adding additional layers to the tech stack, the case for cybersecurity spend can certainly be made, and why the CISO, known as the Chief Information Security Officer, is increasingly finding a seat at the table of the board to bridge the gap between security needs and finances. In fact, your CISOs are reporting into the CFOs at this point. Gartner predicts that by 2025, lack of talent or human failure will be responsible for over half of significant cyber incidents, and the consumerization of AI-enabled fraud will fundamentally change enterprise attack surface, driving more outsourcing of enterprise trust and focus on security education and awareness. Microsoft, the biggest investor in OpenAI, has launched Security Copilot. Copilot's AI assistant helps cybersecurity professionals use prompts to make sense of threat intelligence and investigative incidents. Palo Alto Networks leverages threat detection logs in its AI-based security operations center platform. CrowdStrike has equipped its Falcon platform with AI capabilities. There are also a number of cybersecurity startups in this space. Global cyber spend is expected to reach $219 billion in 2023 and grow to nearly $300 billion in 2026, according to IDC. Software, the fastest growing segment, will capture 47% of all cybersecurity spending this year, followed by services at 39% and hardware at 13%. And of course, this is according to IDC's forecast.
And of course, all this generative AI really sort of kicked off with OpenAI and Sam Altman there. And according to sources at The Information, they might be planning to turn ChatGPT into its own co-pilot, essentially potentially being a rival for Microsoft and some of these companies that thought they were going to just benefit from ChatGPT. How do you think that might change the mix?
You know, it's interesting when it comes to ChatGPT because companies are leveraging it in different ways that fits their needs based on, client profiles and what they're trying to do with it at the end of the day, right? So it's about all the input that goes in and how they're leveraging the output that comes out. So a technology company might use ChatGPT in a certain way or whatever generative AI platform they decide to leverage versus an industrial company, manufacturing company, healthcare company. They have different needs for different types of clients.
So certainly a lot of room. Everyone has some room here. As you mentioned, there are different needs and different size companies as well. A big thank you there to Jill Malandrino there, Nasdaq Global Markets Reporter. Thank you so much.